Pranam. In this section of my course Financial Accounting 101, I will try to explain some of the accounting principles, concepts, and conventions as they are critical to understand not just the routine accounting but also the creativity that the accountants add to the accounting. Accounting is often called the language of business through which a business house communicates with the outside world. In order to make this language intelligible and commonly understood by all, it is necessary that it should be based on certain uniform scientifically laid down standards. These standards are known as accounting principles. In short, accounting principles are guidelines to establish standards for a sound accounting practices and procedures in reporting the financial status and the periodic performance of the business. These principles can be classified into two categories: accounting concepts and accounting conventions. Accounting concepts are defined as basic assumptions on which or on the basis of which financial statements of a business entity are prepared. They are used as a foundation for formulating various methods and procedures for recording and presenting the business transactions. Let us discuss some of the most important accounting principles. So as you can see over here, the first accounting principle mentioned is the business entity concept. According to this concept, business is treated as an entity separate from its owners. It is treated to have distinct accounting entity which controls the resources of the concern and is accountable thereof. Accounts are prepared for a business entity as distinguished from the persons owning it. All transactions of business are recorded in the books of accounts from the point of view of the business. Transactions are also recorded between the owners and the business. For instance, when the capital is provided by the owner, the accounting record will show that the business has received so much money and is owning, or it is owing to the proprietor or the owner. So it owes back to the owner. This concept is based on the sense that the owners entrust the resources to the management and the management is expected to use these resources to the best advantage of the firm and to account for the resources placed at its disposal. The failure to recognize the business as a separate accounting entity would make it extremely difficult to evaluate the performance of business, since private transaction would get mixed with the business transactions. The overall effect of adopting this concept is, number one, only the business transactions are recorded and reported and not the personal transactions of the owners. Income or profit is the property of business unless distributed among the owners. The personal assets of the owners or shareholders are not considered while recording and reporting the assets of the business entity. The second concept over here is the money measurement concept. Money measurement concept holds that accounting is a measurement and communication process of the activities of the firm that are measurable in monetary terms. Thus, only such transactions which can be interpreted in the terms of money are recorded. Events which cannot be expressed in terms of money do not find a place in the books of accounts, though they may be very, very important for business. Non-monetary events like death, dispute, sentiments, efficiency, etc. are not recorded in the books, even though this may be having a great effect on the business. Accounting, therefore, does not give a complete account of the happenings in the business or an accurate picture of the condition of the business. Thus, accounting information is essentially monetary in monetary terms and is quantified. The system of accounting treats all units of money as same, irrespective of their time dimension. This means that the 1 rupee earned on the 1st April, that is at the beginning of the year, has the same value that you earn on 31st March, or say at the end of the year, which definitely corporate finance will say it's wrong because there's something known as time value of money that comes in between. The third concept in accounting is known as the cost concept. According to the cost concept, the various assets acquired by a concern or a firm should be recorded on the basis of the actual amounts involved or spent. This amount or cost will be the basis for all subsequent accounting for fixed assets. The cost concept does not mean that assets will always be shown at cost. The fixed assets will be recorded at cost at the time of its purchase, but it may be systematically reduced in its value by charging depreciation. These assets ultimately disappear from the balance sheet when their economic life is over and they have been fully depreciated and sold as scrap. It may be noted that if nothing has been paid off for acquiring something, it would not be shown in the books of accounts as an asset. Concept of cost, or say cost concept, is not much relevant for the investors and other users because they are more interested in knowing what business is actually worth today rather than the original cost of the asset. The fourth concept is known as the going concern concept. Business transactions are recorded on the assumption that business will continue for a longer period of time, or say for infinity. There is neither the intention nor the necessity to liquidate the particular business venture in the foreseeable future. Therefore, it would be able to meet its contractual obligations and use its resources according to the plan's predetermined goals that they have. It is on this concept that a clear distinction is being made between assets and expenses. Transactions are recorded in such a manner that benefits likely to accrue in the future from money spent now or future consequences of the events occurring now are also taken into consideration. It is because of this concept that fixed assets are valued on the basis of cost less proper depreciation, keeping in mind their expected useful life, ignoring the fluctuations in the prices of this asset. However, if it is certain that the business will continue for a limited period of time, then the accounting records will be kept on the basis of expected life of business, and there will be no need for such detailed accounting information as to revenue and capital expenditure. When the entire enterprise liquidates a branch or one segment of its operations, the ability of the enterprise to continue as a going concern is not impaired. But the enterprise will not be considered as going concern if it goes into liquidation or it becomes insolvent. If the assumption of going concern is not valid, the financial statement should clearly state this fact. The fifth concept is known as the dual concept of accounting. This concept is based on a double entry bookkeeping system, which means that accounting system is set up in such a way that a record is made of two aspects of each transaction that affects the record. Every financial transaction has dual aspect. First, we get some benefit, and second, we pay some benefit. The sixth concept is known as the concept of revenue recognition. There are two versions of which of this concept, when that is so as to when to recognize a sale as a sale and expense as an expense. Number one is the cash system. Under the cash system of accounting, the sales is recognized only once money is received. However, under accrual system of accounting, a sale is recognized once the legal obligation to pay and the legal right to receive accrues. Most of the businesses follow accrual system of accounting, whereas professionals having small practice and small business only follow the cash system of accounting. So please remember that most of the things that we are going to learn will be based on accrual system of accounting. Again, what is accrual system of accounting? It is that system in which a sale is recognized once the legal obligation to pay and the legal right to receive accrues. Okay. So seventh accounting concept is known as the accounting period concept. As per the going concern concept, business is a never-ending entity. The result of a game is known only once it ends. Hence, it is customary that the life of the business is divided into appropriate parts known as an accounting period. Normally, the accounting period is of 12 months. In India, we go from a financial year from April to March. The eighth concept is known as the matching concept. This concept is based on the accounting period concept. In order to determine the profit earned or loss suffered by the business in a particular defined accounting period, it is necessary that all the expenses of the period should be matched with the revenues of that period. The term matching means appropriate association of the related revenues and expenses. Therefore, income made by a business during a period can be ascertained only when the revenue earned during the period is compared with the expenditure incurred for earning that revenue. According to this concept, adjustments should be made for all outstanding expenses, accrued income, unexpired expenses, unearned incomes, etc., while preparing the final accounts at the end of the accounting period. Let's take an example over here. Think over that you have taken a loan to erect a plant. Okay. Now what happens is that you are erecting a plant you started from April and you started to pay the interest, which is at 10 rupees per month. Okay. So your plant was up for production in the month of say January. So from April to December, that is a 9 months, the interest that you have paid, that is 10 rupees into 9 months, 90 rupees, is not an expense for this year because that expense has not led to the accruation of any revenue. However, the interest that you will be paying from the month of January till April will definitely form a part of the expense, because for that much part the productivity of the plant had came into place. Okay, so matching concept is very, very critical. The next we can see is the accounting conventions. The term convention denotes customs or traditions or practice based on general agreement between the accounting bodies which guide the accountant while preparing the financial statements. It is a guide to the selection of application of a procedure. In fact, financial statements, namely the profit and loss account and the balance sheet, are prepared according to the following accounting conventions. Number one, as mentioned over here, is consistency. The consistency convention implies that the accounting practices should be remaining same for from one year to the another year. The results of different years will be compared only when, or say comparable only when, accounting rules are continuously adhered to from year to year. For example, the principle of valuing stock at cost or NRV, whichever is lower, should be followed year after year to get comparable results. The rationale behind this principle is that frequent changes in accounting treatment would make the financial statements unreliable to the person who uses them. The consistency convention does not mean that a particular method of accounting once adopted can never be changed. When an accounting change is desirable, it should be fully disclosed in the financial statements, along with its effect in terms of rupee amounts on the reported income and financial position of the year in which the change has been made. The number two is the full disclosure part. Apart from statutory requirements, good accounting practice also demands all significant information to be fully and fairly disclosed in the financial statements. Now, all information which is of material interest to proprietors, creditors, investors should be disclosed in the accounting statements. This convention is very important, and most of the big business units are in the form of joint stock companies, where the ownership is diverse from the management. The Companies Act makes ample provisions for the disclosure of certain of say essential information, so that there is no chance of material information being left out. Third one is the concept of conservatism. Financial statements are usually drawn up on conservative basis. There are two principles which stem directly from conservatism. Number one, the accountant should not anticipate income and should provide for all possible losses. And number two, faced with the choice between two methods of valuing an asset, the accountant should choose a method which leads to lesser valuation. The examples can be, say, making a provision for bad debts in respect of doubtful debts, amortizing the intangibles like goodwill, patent, trademark, etc., as early as possible, assuming that you might not be able to get the benefits of these assets in the future, valuing the stock in hand at lower of cost or NRV. The fourth one is the materiality. According to the convention of materiality, accountants should report only what is material and ignore all insignificant details while preparing the final accounts. The decision whether transaction is material or not should be made by the accountant on the basis of professional experience and judgment. Any item may be material for one purpose while immaterial for the another purpose. For the items appearing on profit and loss account, materiality should be judged in relation to the profits shown by the profit and loss account. And for the items appearing in the balance sheet, materiality should be judged in relation to the groups to which the assets or liabilities belong to. Example, for any item of current liability, it should be judged in relation to total current liabilities. So these are the critical concepts and conventions of accounting, which you should understand so as to understand the course as we go ahead. Thank you so much.